Back to my channel. This is Tarun, Air 11 guy. So today we are discussing about the part 2 of capital gains. Before seeing this video, my request is first of all see the part 1 which is only 20 minutes about the capital gains, which contains the basic things about the capital gains and rates of taxes. So today topics are the so now let's move on to part 2 of the capital gains. First of all, previously we ended at the forfeiture of advance. Now we are starting from year of chargeability of the capital gains. Normally, capital gains will chargeable at the time when the transfer takes place. But in the exceptional cases, it will be chargeable at the time of the sale or at the time of the transfer of the final good. That is the in case of conversion of a capital asset into stock in trade. That is, if you are starting a real estate business, you are converting your house into the uh, any kind of the stock in trade. So in that case, uh, the house will be chargeable as a capital gain on the date when the that stock in trade is sold in the real estate business. That is, if you are transferring as of 10th December 2024, and that conversion will happen on 10th December, and that house is sold on for example 1st January 2025. In that case, the asset will be taxable under the capital gains on the date when the stock in trade is sold. That is the 1st Jan 2025. On that day, what is the sale value is the business income. So business income is the sale value of that stock in trade minus fair market value as on the date of conversion. If the for example you are transferring the asset on 10th December 2024, so on that date what is the fair market value of that house? So from that you compute the capital gain. So for the computation of the capital gain, our basic sale value is the fair market value of the asset as on the date of conversion minus any kind of the cost of acquisition. So whatever you incurred for the acquired of that asset. From the for the benefit of indexation, you compute the holding period from the date of acquisition to from the date of conversion of that asset. That is the 10th December 2024. What is the indexation value on that year? Okay, and both the capital gain and business income is chargeable at the time when that stock in trade is sold to final consumer. Okay, this is the section of 45 subsection 2. You don't need to remember the sections. So in case of insurance receipts, that is a way, if any asset is destructed, so we get the insurance from the insurance company. In that case, capital gain will arise when the amount received from that insurance company. If any capital gain arises, so capital gain is taxable on the year when that amount is received from that insurance company. And compensation received under compulsory acquisition. This is a if the government acquired any asset belongs to us, and for any reason which is reasonable in nature, for example construction of a road, construction of any kind of hospitality or building of a road. So in that case, government will give the compensation for us. If the compensation is if the compensation received later, the day when the compensation received is the chargeability of the capital gain. Okay, and if you don't, and if you do not satisfy with that compensation given by the government, now you can now you can file a case for the enhanced compensation. That is the enhanced compensation. In that case, entire enhanced compensation is taxable under capital gain by deducting the any kind of the small nominal fees, that is a lawyer fee for the court case, etc. And holding period in these two cases are the holding period in case of the destruction of capital asset is the date of acquisition to the date of destruction, and in case of compulsory acquisition is date of acquisition to the date of government acquired that asset. Okay, and in the third case, if any interest is received from the government, it will chargeable as income from other sources under section. It will chargeable under the income from other sources by deducting the amount of 50 percentage of the by deducting the 50% from that interest. Like if the government acquired as on the 30 March 2021, now government given the compensation for that acquisition on as on the 31st December 2025. So from this period you get an interest amount on that compensation. So that interest you can reduce the 50% from that interest value. So remaining 50% is taxable under income from other sources. And let's move. What is a cap under section 50B? What is the slump sale? For if the slum, first of all, know the meaning of this slump sale. If you have a business of, for example, alcohol business, you have a 6 units entire Hyderabad. for example, you are selling the 1 unit at the 1 unit at Amirpet. So in that case, the capital gain arising from the sale of that 1 unit of your business. So in that case, what is the sale value and what is the cost of acquisition? Here section 50B will talk about, will tell the what is the sale value and what is the cost of acquisition. First of all, this is come under third category, that is 36 months. If it is for the new under new amendment for May 2025, it is come under the 24 months second category. Okay, so it is taxable under the long term capital gain as 20% for the old for the Jan 25, and long term capital gain at the rate of the 12.5% for the May 25, and is now for the short term 20% is the taxable rate for the May 2025. So what is the sale value? Sale value is the fair market value of that unit on the date of the sale, or say actual sale value you are selling to the another person, whichever is higher. And what is the cost of acquisition? Cost of acquisition is the total assets minus total outside liabilities. Assets we are taking the only after deducting the depreciation, and liabilities are taking the book value, that is which we owe to another outsider liability outsiders. So in case of the depreciable assets, we compute the depreciation under section 32 of the Income Tax Act, which you will learn from PGBP. And main note is the you should ignore the revaluation amounts, whatever we made the revaluation to the assets. So let's move the simple example of the slum sale. Here, Mr. Akash Entrepreneurs sold having a 2 units and and sell the 1 unit by slum sale, and the total consideration is the 25 lakhs, but the unit 1 fair market value is the 30 lakhs. So higher of this amount is the 30 lakhs. So sale value is the 30 lakhs, and the expenses incurred on sale is the 28,000. Okay, your expenses incurred on sale is 28,000, and we deducting the cost of acquisition, that is we call it as a net worth in the slum sale. Okay, and here land value excluding the revaluation amount, that is a 9 lakhs, and remaining amount are after the depreciation. Okay, you can see from the textbook also this example. Basically depreciation rates are the 10% for the building and furniture, and 15% for the plant and machinery, and 25% for the intangible assets, and there is no depreciation for the goodwill. In case of the sale of depreciable assets, if the company sell the plant and machinery, that is it is not a stock in trade for that company, so this will be equal to the capital asset, right? So in that case, any sale of depreciable assets by the company, it will always treated as a short term capital asset. If the gain arises, that is a short term capital gain. Okay, if the company transferring the depreciable assets, that is sale value is more than the written down value as on the date of the sale, that is as on the date, then the entire amount, that is the sale value minus entire block of entire WDV of the that block. For example, we have 8 machineries with written down value of the 15 lakhs, and if you are purchase the 2 machineries for 5 lakhs, in the case 2, first move to the case 2. In the case 2, 6 machineries are sold for the 23 lakhs. This is the, so what is our the, so what is the remaining amount after the sale? That is the written down value plus purchases minus sale value is the 3 lakhs. So this 3 lakhs is the capital gain, which is chargeable as a short term. If you are selling the 6 machineries for 8 lakhs, in that case the remaining WDV is the 12 lakhs. So in these 12 lakhs, you charge the depreciation under section 32. Okay, for the simple understanding of the topic, we see if the sale value is more than the consideration of that block, then entire amount, what is the capital gain, will chargeable as short term. And if it is less than the written down value, if the block does not exist, if we sold the entire 10 machineries here, then there is this 12 lakhs is a loss for us, right? If there is no assets in the block, so what is the meaning of the remaining 12 lakhs? Obviously it is a loss. Okay, so if the block does not exist, remaining we charge as a depreciation. If block exist, we charge the depreciation. If block does not exist, that is we sold the all 10 assets, in that case it will obviously the short term capital loss. The most important topic we got you expect an MCQ from this is, if any asset distributed by a company to the shareholder, it will chargeable under the capital gain. That is first of all you see whether the company is distributing out of a accumulated profits. If it is distributing from the accumulated profits, it will chargeable as a deemed dividend under the income from other sources. That is the section 222C. If any amount other than the accumulated profits, any kind of money or asset received minus what is already chargeable under the 222C, that is the deemed dividend, the entire amount is chargeable as a capital gain. So, and one of the another concept is the reverse mortgage scheme. In for example, first of all, we know the another concept is the reverse mortgage scheme. So you should know the what is the reverse mortgage scheme. If a person who is a senior citizen is mortgage their land or any house to the bank without any burden of without bothering the sale of that land by the bank, and that senior citizen do not have any income chargeable under the profit PGBP section. So in that case, first of all, it is not a transfer under section 47, and any amount received by the person under the reverse mortgage scheme will exempted under 1043. So there is no capital gain arises because there is no transfer at all in this case. And the main concept in the capital gain is, by if you need to complete the answer for the capital gain question, you should know the exemptions in the capital gain. That is first exemption is the section 54. In this exemption, if you are selling the residential house property, first of all, it is eligible to individual and the HF only, but it will not eligible to any company or partnership. Okay, and condition is first you should transfer the residential house property, and it must be a long term capital asset. So if you are selling the short term capital asset, then there is no exemption under this section 54. Exemption is available only when you invested in the another asset. So mainly government giving the exemption when you are investing the amount of the sale on any another asset. So what is the time limit for investment? If you purchase the within 1 year before the date of the transfer or within the 2 years after the date of the transfer, it will allowable as exemption, and are constructed within the 3 years after the transfer. Within the 3 years, construction to be completed within the 3 years. If the capital gain is more than the 2 crores, then you can purchase only one asset. Otherwise, if the capital gain is less than or equal to 2 crores, you can purchase the two assets, but within India only. Exemption is available if you purchase any asset within India only. The reason of giving the less than 2 crores for the two assets is, if a person gaining the two less than or equal to 2 crores, obviously he is a middle class person, and is selling the amount and buying the another two assets. So in that case, government giving the exemption who ever capital gain is less than the 2 crores. Okay, and main is the amount of exemption. Amount of exemption is lower of the actual capital gain value and maximum 10 crores and amount invested in that asset, in that new asset. And what is the period of holding of that new asset? If you are purchasing the asset, then you are selling the within the 2 months only, then what is the main intention of that giving that exemption? So government made an holding period of 3 years is the holding period, so you should hold until that period. If you sell that asset on any reasons, then the amount of uh, in that case, what is the cost of asset? So actual cost minus already amount taken as exemption. So you are getting the exemption amount to be taxable in this case. Okay, so if you are so if any relative in your family selling the asset, give an advice to purchase the new asset or amount to be transferred to capital gain account scheme. So we'll discuss what is the capital gain account scheme on later. And second is the 54 EC. This one is any sale of the land or building and invested in the specific bonds. The entire capital gain deductions exemptions is about when you are only investing the any other assets. So these sections are depend upon the on what asset you are invested. First one is the invested in the, so you must invest in the any residential house property, right? In the second case, you invested in the specific bonds. You should be invest in specific bonds only. So what are the specific bonds? National Highway, any bonds issued by the National Highway Authority of India and Rural Electricity Corporation Limited and Power Financial Corporation and Indian Railways. You may remember this highway authorities and railway authorities and power distribution authorities. So you can easily remember these authorities whom from whom do we purchase the bonds. So in this case is the time limit they given only 6 months. Within the 6 months of the transfer, you should invest the in that bonds. Otherwise, you don't taken as exemption under section 54 EC. So what is the amount of exemption? Amount of exemption is the capital gain or maximum 50 lakhs in this case. In the previous case, the maximum amount is the 10 crores, but here only 50 lakhs. And amount invested in the specific bonds, whatever the actual amount invested in that bonds. So holding period is different in this case. Holding period is the 5 years. You should hold until 5 years from the date of the purchase of that specific bonds. So identify what is the difference between the 54 and 54 EC. Actually, in 54, you should purchase the asset which is the residential house property. In the 54 EC, you should purchase the specific bonds. And the holding period is also different. And purchase period is also different. Here, you purchase the within 1 year or 2 year. But here, you should investment within the 6 months of transfer only. And the amount of maximum amount of deduction is different. Here 10 crores. Here is only 50 lakhs. And another one is only for the long term capital asset. Transfer of a long term capital asset is the 54F. In this case, you may transfer the any asset other than residential house property, but you should invest in the only residential house property. Here is case is a capital gain in case of investment in the residential house property. But condition is do not transfer residential house property. You may transfer the any asset, but you don't transfer the residential house property. That is the house property. And that person do not own any house on the date of the investment in that new residential house property. So time limit to invest is the same as section 54. That is the 2 years within the date of the transfer or 1 year before the date of the transfer in case of purchases. In case of the construction, within the 3 years of transfer. So what is the amount of exemption? Here you should the main thing in this case is the amount of exemption. Long term capital gain into lower the amount of lower of amount invested, whatever you are invested in the new residential house property are 10 crores, okay, and divided by the net consideration. So in this case, the amount of exemption formula is important, and the holding period is same as 54. That is the 3 years from the date of the acquisition of that new asset. And in these two cases are the sale of the agriculture land and compulsory acquisition by the government of any industrial undertaking. So let's move on to this. Under section 54B, if any person selling, that is the individual and HUF, selling the only transfer of urban agriculture land. So you should remember that transfer of a rural agriculture land is not a capital asset. First of all, it is not a capital asset, so it is not chargeable as a capital gain. If any case you are selling the rural agriculture land, so it is not chargeable as a capital gain, okay. And that land should be used for the agriculture purpose by you only or your parents preceding the 2 years from the date of the transfer. For example, if you are transferring the today 10th December 2024, and that land should be used for agriculture purpose before 2 years from today, okay. And the time limit to invest in the new land, you may purchase either rural or urban agriculture land, that is within the 2 years from the date of the transfer of that urban agriculture land. And in this case, this one is a simple amount of exemption is amount invested in the new asset or capital gain, whichever is lower. And the holding period is same as section 54, that is the 3 years. You don't need to remember for this holding period for all the sections. And in case of the capital gain, by way of capital gain on transfer by way of the compulsory acquisition, the government acquired any land or building, it is used for the industrial undertaking. Industrial undertaking means if you are running the business on that land or any building, so that will called as the industrial undertaking under section 54D. So this will available to any person, either individual, HUF or partnership or company. Condition is such land or building used for the business purpose, that is the industrial undertaking, by the assessee before the 2 years from the date of the transfer, as like as above. And time limit to invest is here 3 years. Before is the 2 years, but here is the 3 years. But here is the 3 years. And amount of exemption is the amount invested in the new land or building. Only it is used for the business purpose. And what is the capital gain, whichever is lower. Holding period is the same, that is the 3 years. And let's see what is the capital gain account scheme. If any person did not able to invest the amount into that new asset within the specific period, you may also transfer the amount to capital gain account scheme for the availing the exemption under those above sections, okay. So if you are first of all, government should know that whether you are investing in the new asset or not. For this purpose, government has given a account, that is a capital gain account scheme. whatever the capital gain your arises, you should transfer this amount to the capital gain account scheme. If you are not purchasing the asset into the within the date of filing of the income tax return, that is the 31st July. So in that case only, on filing the return, government know you are purchasing the asset on a later period, so we can give the exemption to this person about the above section, that is section 54 and section 54 EC, section 54 F. And what is the unexhausted basic exemption limit? So first of all, understand the unexhausted basic exemption limit. Let's see one of the example. If the income of a Mr. Vamshi is 20 for Mr. Vamshi is a 24 years and his income is the salary is a 50,000 per year and income from other sources is a 10,000, and capital gain under section 112A, that is the long sale of the equity shares for the long term period, that is the 3 lakhs, and under section 11 under section 111A, capital gain is the 1,50,000. So totally 5 lakh 10,000 is the capital gain, and his special income is the 4 lakh 50. So these are called as a special incomes, okay, because these are chargeable as a separate tax rates. And normal income is the 60,000, that is a salary plus IFOS. And basic exemption limit for the 24 years less than the 60 years is the 2 lakh 50. So amount after the these normal income deduction is the unexhausted basic exemption limit is the 1 lakh 90,000. 2 lakh 50,000 minus 60,000 is the unexhausted basic exemption limit. So first you should understand the what is the unexhausted basic exemption limit. So let's see, these unexhausted basic exemption limit shall be deducted from the section 11A and 112A and 112, but it will not applicable, it could not be deducted from the section 115B, that is the casual income, that is income from the horse races or bettings, gamblings. And section 115BA, there is a black money. Yeah, for this money you do not have any explanation, that is not accountable, okay. So you should understand the from which income you can take the unexhausted basic exemption limit. So under section 112A, up to 1 lakh is there is no tax. So 3 lakhs minus 1 lakh is the 2 lakh is the actual taxable amount. So you can deduct the 1 lakh 90,000. Ultimately 10,000 is the taxable amount at the rate of the 10% under the old rates. If it is in the new rates, it will change the 1 lakh 25,000 is the basic 1 lakh 25,000 is the deduction and 12.5% is the taxable rate. Under 111A, rate is the 15%. If it is for the May 2025, rate is the 20%. So I can I taken the old rates as a base. So my tax is the 23,500. Here my total income is the 5 lakh 10,000, which is greater than the 5 lakhs. So rebate is not applicable in this case. So let's see the in which sections, for which sections rebate is applicable. Under section 87A, rebate is applicable to all the sections except 112, because it is for this section government has already given the limit of 1 lakh exemption. If it is for May 2025, 1,25,000 is the exemption, okay. So that's why rebate is not given for these sections. So you may deduct the rebate of 12,500 from here if the income is less than the 5 lakhs, okay. So let's do the at least 2 questions on the capital gain, so you can be able to understand the overview of the capital gain chapter. So Mr. Yuvika bought a vacant land for the 80 lakhs. This is the cost of acquisition in May 2005, and the registration charges were 10%. That is the 8 lakhs. So cost of acquisition include the what are the cost which are acquired for that asset, also you include the cost of acquisition. And she constructed the building at the rate of the 100 lakhs in 2007-2008, and she entered into the agreement for the sale of the above residential house on April 2015. So in this case, advance was the 20 lakhs and the advance executed was the 20 lakhs, and the advance was forfeited because of not materializing their agreement, okay. So in this case, this advance forfeited on or after 1/4/2014. So you may remember this section 50. So in this case, you get that if any advance forfeited on or after 1/4/2014, so it will be taxable under the IFOS, okay. So you should write the note in the below of the answer. So this amount is chargeable as a income from other sources. Then only you will get the full by full marks. And finally, she sold that asset for the 810 lakhs on 1/5/2024, and she received the 80 lakhs as advance by RTGS. So if any advance received before on other than the cash bearer check, cross check. In that case, the date of advance, what is stamp duty value on the date should be considered as a actual sale date is the 14/7/2024, and stamp duty value on the date is the 900 lakhs. Okay, so you should know the every provision to do that answer. So in this case, this stamp duty value should not need not to consider, and 1% is the brokerage, that is expenses on sale of the asset, and they given a in which they are invested, that is acquired the two residential houses at Delhi and Chandigarh. These two places within India only. One is for 130 lakhs and one is for the 50 lakhs as on 31/1/2025 and 15/5/2025. These are within the 2 years from the date of the transfer. So they are purchasing that asset. So time limit is 2 years. And acquired a residential house at UK. This is outside India and there is no exemption in this case. And cost of acquisition is 180 lakhs. And also subscribe to NHAI, that is the National Highway Authority of India bonds approved under section 54 EC. Amount is for the 50 lakhs on 31/11/2024 and 40 lakhs as on 9/1/2024. So these are within the 6 months period only. So compute the capital gain. Here they given the CA values, that is the cost of inflation index values based upon the year. So let's move the quick glance on the answer. So obviously the sale value is the okay. Here difference between is not exceed the 10%. So actual sale value is the does not exceed the 110%. That is the 10%. So actual sale value is the sale value minus brokerage and cost of acquisition and cost of improvement also here is there. That is the building, construction of a building. You should compute the based upon the indexation. So this is the long term capital asset. So you should compute you by using the indexation benefit. And you transfer the asset and also you invested the asset. So you can claim the exemption under section 54 and section 54 EC. Here section 54 EC maximum limit is the 50 lakhs. So you can take the 50 lakhs. But here the capital gain is the more than the 2 crores, that is the 2 crores 47 lakhs. So if the capital gain more than the 2 crores, you can claim only for the one asset within India only. So for the beneficial to the assessee, you can claim the higher asset value, that is the 130 lakhs. Okay, here two assets will not be allowed as exemption, only one asset is allowed because of capital gain is more than the 2 crores. So let's see a quick recap rate of the another question. Here house property purchased for 3,24,000 on 1979. This is before 2001. And he also paid the stamp duty value at the rate of 10%. This is the including the cost of acquisition. That is overall asset value is the 3,50,000. Here he paid the 10% on the stamp duty value, that is that 3,50,000. That is 35,000 is the cost of acquisition. It is also including the cost of acquisition. And Mr. Shiva entered into an agreement for the sale of the value, and he also received the advance for 1,11,000. Here in this case, he forfeited the advance. So when he entered into agreement is a 2018. So this is the before the 1/4/2014. So you should remove that advance value from the cost of acquisition. So let's see. And here on April 2001, fair market value was the 11,85,000 and stamp duty value was 10,70,000 only. So if you recall that, so if we recall the section 50C amount, if we cost indexation cost of acquisition, we got cost of acquisition or fair market value as on 1/4/2001. But fair market value does not exceed the stamp duty value as on 1/4/2001. So here you should take the fair market value as the stamp duty value, that is 10,70,000 only. So let's see the answer. Here they taken only 10,70,000 and by removing the amount, that is advance forfeited, that is a 1,11,000. Okay. Like this you should match the every concept with the answer, then only you can be able to remember the those provisions with clearly manner. So thank you for watching the video. If any doubts arises, please comment on the video. I will go through it and try to clarify those doubts. You may download my you can download this entire notes on the capital gain from the description of my video.